retail inflation for the month of July easing to 1.55%. That's the lowest reading in 8 years. Food prices were contracted, hitting the lowest level in 6 years. Latha standing by to decode the inflation fine print for us. Latha, good news clearly on the inflation front.
Well, good news, but the surprising word I'm going to use is that it is higher than expected. Our own poll expected 1.3. So although 1.55 looks ridiculously low for an India inflation number, the poll had actually thrown up 1.3. But to be fair, there was a wide, there was quite a range. There were two people actually, SBI and Citi, two very prominent economists who were expecting as low as 1.1. So that dragged the average down. Even otherwise, my average would have been 1.4. So you will have to say that the July inflation number has come in slightly higher than what the street expected. There were some numbers floating around at 1.7, but those were few and far between. Almost everyone was at 1.4 at best. So this is a bit of a surprise, you will say. And food inflation perhaps is the one that surprised a bit. The number that I had was minus 2%. It's actually come in at minus 1.7%. So perhaps that's why the number is slightly higher. The headline number is slightly higher than what we thought. What's been dragging down food have been the two heavyweights, cereals and pulses. They're falling even month on month, mind you. Usually during the monsoon months, you start seeing these food prices rise because of dislocation of, movement of goods. But nothing of that kind because of the excellent monsoon, early monsoon. We have actually had a salutary impact on food inflation expectations. That's also keeping food prices down. So you're seeing these two heavyweights, cereals and pulses, down month on month. Cereals is down 0.1% month on month and pulses is down a whole 1% month on month. But let's look at the year-on-year figures, which is, the correct way of looking at it because this is a seasonally adjusted product. Cereals are up 3% on the year. But the most important point to note is that edible oils are up 19%. That's the carry forward of the higher tariffs that were imposed. Fruit and vegetables, again, are down 20% year on year. That's because last year we had very high prices for potatoes and onions. And that explains why the inflation numbers have been coming so much lower in year-on-year terms at 1.5%, as you just saw. The other important number I should point out is the non-food, non-fuel inflation, core inflation, has come in at 4.1% compared to 4.4 last month. Last month, in June, it was 4.4. This month, July, it's coming in at 4.1. That's also because the base effect is wearing out. The base was very low for core inflation in the first half of the year. That is, 2024 had 3% core inflation up until June, and then it starts picking up a bit. So that's why we are seeing core inflation come down. But there have also been global prices, Asian prices of some metals falling, and that could be having an impact, a mild impact on our core inflation as well. Core inflation is also services inflation in our case, and some of that is also going down. So all told, the inflation number at 1.5% is mildly higher than what we expected, but well in line with what the RBI is saying. RBI has brought down the full year forecast from the earlier 3.7 to 3.1. So this 1.55 gels very well with the RBI's expectation. This will perhaps push yields higher. It bolsters what the Reserve Bank told us on August 6th. It didn't give us much of a hope that there will be yet another rate cut. For the bond markets, bond yields have already picked up. They are now 10-year is at 6.46. I think we should pull up the 10-year yet again. It's reacting very harshly to the numbers because from the word go, from August 6th, when Reserve Bank indicated that it is not in any dovish mood, the yields have been picking up. A further reason why it's picking up is fiscal deficit. Because the nominal inflation, nominal GDP is expected to be low, there are fears that the fiscal deficit will be high. The fiscal deficit is expected to be higher than the 4.4 estimated by the budget. Also because tax collections may be lower given the uncertainty on the tariff front and the generally lower consumption and investment that is expected from the private sector. All told, bond markets in India are in the dumps, as you can see. 6.46 47 now as we speak. The lowest that the 10-year saw was, imagine, 6.17 in end May, when we were expecting, inflation to come down and a generally good tariff situation as well. No such luck. At the moment, it's 30 basis points higher than the low about 2 months back. So, well, not a very, it's a good inflation number, but not much cheer for the bond market. Even this good inflation number, we will celebrate for 2 hours. After that, we are going to focus on the US CPI numbers. That's ruling the roost.
All right, Latha, we'll take that 2-hour celebration for now. But thanks very much for joining us. In fact, Latha will be joined by economists in less than 30 minutes to analyze the numbers for us. But the big story that's moving the market